tax considerations when moving overseas. That's the topic for today's Live Invest Overseas podcast. I'm Leif Simon, the Live Invest Overseas answer man, and Kathy's left me on my own today because, well, she doesn't like to talk about taxes. She and I spoke at an AICPA event, the American Institute of Certified Public Accountants, and many of the attendees there had questions about overseas taxes and what Americans should be considering when they move to another country. So I've culled some of those questions from that presentation to answer here for you, our podcast listeners. The first one is really at a high level, what are the tax considerations when moving to another country? And it's mostly fairly straightforward. You have income taxes, capital gains taxes like you would in the U.S. The one question to ask up front is there a tax treaty with the country that you're moving to with the U.S.? If there is, that might make your tax planning a little bit easier. If there's not, don't worry. That doesn't mean you're going to be taxed twice on your income. You're going to be able to get a tax credit for any taxes you pay in one country versus the other. It just depends on which country, the U.S., if the income's earned there, or the country that you're moving to gets first tax bite, so to speak. But pretty much every country has a tax credit, as does the U.S. So, for example, you're a retiree, you move to, say, Portugal, you're taxed on your IRA income in the U.S., you're taxed on your IRA income in Portugal. The tax treaty determines which country gets first bite. Then if there's anything else that needs to be paid in the higher tax jurisdiction, then you get a tax credit against that in that country. So not totally straightforward for you, but the one key thing to remember is take tax advice in advance of moving to your new country, because you can do some tax planning, and where it gets some other questions that you definitely want to do some tax planning before you take up tax residency in another country. The other thing to consider moving to another country, and there's very few of them that have this, but is their wealth tax. If you have a high net worth, you want to ask that question of your tax advisor before you move to a country, again, to decide whether or not you want to do some tax planning in advance, or if you have enough wealth, maybe you decide not to move to that country, but move to a country next door that doesn't have a wealth tax. And then there's estate taxes, inheritance taxes to consider as well. And again, want to seek advice before you become a tax resident so that you can understand what those rules are and how they would interact with the U.S. Estate tax rules. So those are the four key things: income and capital gains taxes, potential wealth taxes, and potential inheritance taxes. Not every country has inheritance taxes. And for estate planning purposes, there's also some issues in countries where your assets are going to go to who the government lays out, not necessarily who you lay out. So you want to ask, again, what those rules are and make sure that your assets in that country go to who you want it to rather than who the government says, which is typically blood-related children is the first step. So for a blended family where there's stepchildren involved, if you want things to go equally, you definitely need to do some planning in the countries that only allocate to blood-related children. All right. Then, similarly related is if you're moving out of the U.S., how do you deal with state income tax when you leave the states? Some countries will chase you and expect you to continue to pay state taxes, even though you're no longer living there. California, Massachusetts, Virginia are three of the worst. So if you're coming from one of those states, what many people will do is first change their state of residency in the U.S. to a non-tax state. They'll go to Nevada and establish residency, get a driver's license, Texas, Florida, and then that severs their tie with, we'll say, California again, because that's one of the bigger states and countries that, or state that a lot of people are moving to another country. You sever your ties with California, become a Nevada tax resident, and you don't have to worry about it. Other states aren't, that do have income taxes, they're not as aggressive. So you move overseas, you don't plan on coming back. And intent is a big part of it. If you don't plan on coming back, then you don't have to worry about it for most states. If you're planning on splitting your time and spending some time overseas, sometimes in the U.S., then you're going to have to look at and try and manage and deal with the potential state taxes. But if you're moving overseas full time, you should be able to sever your tax obligation to the state that you're moving from. There's two that kind of come together. So the discussion with clients of whether to give up their U.S. citizenship so not to have to file a U.S. Tax return, and then related to that, which expats have to pay the U.S. quote exit tax upon emigration. So as an American living in the States or overseas, you'll always have to file a tax return. The U.S. is the only country that really requires you to file a tax return. Eritrea charges taxes to non-residents in Eritrea, citizens who aren't resident in Eritrea, but it's a very simplified remittance kind of thing. In the U.S., you've got to file the same tax return as you would if you were living in the U.S., which can add some complications if you have income outside of the U.S. now that you're living in another country. But it doesn't mean you're going to pay any more taxes, and you may not owe any taxes depending on your specific situation. But it's that tax filing requirement that many expats, especially ones working and living in another country, don't want to continue with. So they think about giving up their U.S. citizenship, which is the only way to get rid of your tax filing obligation. The hiccup with that is you have to have another citizenship to be able to give up your U.S. citizenship. So you're not going to be able to give up your U.S. citizenship just by moving to another country. You have to have another citizenship, otherwise you'd end up being stateless, and no government is going to allow you to do that voluntarily. So it's also probably, other than the tax filing compliance, you'll be able to save some time and money dealing with that if you give up your U.S. citizenship, but it comes up with other hiccups. We've known people over the years who've given up their U.S. citizenship and found themselves applying for a green card to move back to the States so their kids could go to high school, for example, in the U.S. So you want to think about it long and hard for giving up your U.S. citizenship, because just giving it up to get rid of the tax filing may not be the best choice for you if you have plans to spend any time in the U.S. visiting grandkids, or if you want to go back and have some medical procedures and have Medicare take care of them, things like that. And so which expats have to pay the U.S. exit tax upon emigration? Well, you're only going to pay the quote exit tax if you are giving up your U.S. citizenship. And it's not quite an exit tax, but it is a capturing of unrealized capital gains when you're giving up your U.S. citizenship, because you can't leave that tax obligation just by giving up your U.S. citizenship. So if you have a net worth of more than $2 million or an income level that I forget the details off the top of my head for the previous 5 years, you have to file this tax return as you give up your U.S. citizenship. But there are big credits, and again, it's a tax on unrealized capital gains. So you want to plan for it and pay attention to it, but you may have zero. If you've got a $2 million net worth and it's all in cash, you've got no unrealized capital gains, and so there is no exit tax. So it's not as onerous as many people think it might be. The next question that they brought up the next couple questions actually had to do with IRAs. And I've been trying to help educate people moving to other countries about the IRAs, because there is a big hiccup and counterintuitive issue here. So how are IRAs taxed in other countries? IRA distributions are taxed as pension payments would be taxed in most other countries. And in some countries, pensions aren't taxed. Panama has a jurisdictional taxation regime. So in fact, no foreign income earned outside of Panama is taxed in Panama. Colombia has a very large exemption for pensions. So unless you've got a huge pension, you're not likely to pay taxes in Colombia. Europe, they will tax your pension distributions, which would include IRAs. And so that gets to the next question, which is what about Roth IRAs, which are tax-free in the U.S., but they wouldn't be considered tax-free in the country you're moving to. So what do you do? Well, the simplest answer, and you should take advice with your tax preparer, your financial advisor, but is to take all the money out of your Roth IRA before you move to another country, before you're a tax resident in another country. This is part of the planning that I mentioned earlier that you can do in advance of becoming a tax resident of another country. But distribute your Roth IRA out. You'll pay no taxes in the U.S. Future earnings from those investments, that money, will be taxed on the U.S. side, but you are eliminating the ability for the distributions to be taxed after you become a resident of another country. And so that's one simple way to look at it. It may not fit your portfolio or your overall planning. So again, speak with your financial planner and a tax advisor in the country you plan on moving to decide what's the best way to organize your affairs before you move to the country. And the last question has to do with IRAs overseas. It's related to the liquidation. It says, so can you move an IRA overseas, or does it need to be liquidated and taxed first? You don't have to move your IRA overseas for you to invest it overseas. You can find an IRA custodian that will allow for what I call non-traditional investments, which is basically things you can buy outside of a stock brokerage account, which would include foreign shares, move your money to a foreign investment planner, real estate, both U.S. and foreign real estate, and some other things. And so if you place your IRA with a custodian that allows for these types of investments, then you can move your investments overseas and maintain your IRA status in the U.S. The other option, of course, is to liquidate and pay the taxes, or in the case of the Roth, not, and move those funds overseas separately. So again, you need to take some tax advice, but you do have options for how to manage your IRA without and invest it overseas without actually taking a distribution and paying taxes. So those were the main questions that came up during our conversation with the people at the AICPA. Please send your questions in to us here at Live and Invest Overseas. Maybe you'll see them on this podcast.